Welcome to this explainer. Look, if you've been casually watching the Japanese real estate market, you might think it's just business as usual. But grab some coffee because the April 2026 government data tells a completely different story. Right under our noses, we are witnessing a massive, structural reallocation of wealth. It's a fundamental rewriting of where money goes, what gets built, and exactly where it gets built.
So here's the billion-dollar question we're going to answer today. Where is the smart money actually moving in 2026? Right now, capital is treating this market less like a playground and way more like a high-stakes survival game. Investors and developers are actively fleeing risky sectors, and they are aggressively seeking out safe havens. We're talking about a full-on flight to safety, control, and guaranteed demand.
Okay, let's map out our journey. We're diving into three major shifts today: the sudden pivot from condos to detached homes, the geographic drain straight into Tokyo, and the logistics boom that is basically eating traditional offices.
Section 1. The Market Illusion. Now, if you just skimmed the latest ministry report, you'd see overall housing starts up 11.4% year-on-year. That's over 62,000 units. You might think, hey, the market's doing great. Capital is still flowing into traditional residential assets. Everything looks green, right? But you know as well as I do, taking raw, unadjusted numbers at face value is a seriously dangerous game.
Because here is the twist. When we actually strip out those temporary fluctuations and look at the seasonally adjusted annualized rate, the illusion completely shatters. The market didn't grow. It actually fell by 1.7% from the previous month. And this isn't just a one-off blip. We're looking at 4 straight months of underlying shrinkage. The market is contracting. And when a market contracts, capital gets incredibly defensive.
Let's move to shift number 1, seeking safety. Check out this stark internal contrast in the built-for-sale segment. Detached houses are surging, up an impressive 24.3%, but long-term condo projects, they've absolutely tanked, dropping over 18%. Think about that for a second. The overall market grew a tiny 3.4%, but that flat number hides a massive rotation. Developers are literally abandoning high-rises to build single-family homes.
So why the sudden sprint away from condos? Well, it all comes down to risk exposure. Developers are getting squeezed hard from both sides by skyrocketing land prices and crazy construction costs. In this environment, a massive condo tower is a huge financial risk. Detached homes, though, way shorter lead times. You build them, you sell them, you move on. It gives developers total control to secure their margins and get out without locking their money up in a multi-year concrete tower.
Which brings us to shift 2, Tokyo takes everything. On the rare occasion developers actually do decide to risk building a condo right now, they're basically only doing it in one place. The Tokyo metro area just absorbed almost 3,300 units, a wild 27.7% expansion. But to feed Tokyo, capital is absolutely starving the regional markets. The Kinki region plunged by over 40%, Chubu dropped nearly 8%, and the rest of the peripheral regions saw a devastating collapse of almost 56%.
It's a ruthless reality. Developers are strictly filtering their locations, essentially confining new high-density projects exclusively to the Tokyo area. And the reason is simple. Tokyo is a fortress of sustained demand. It is the only place developers are confident they can actually pass those massive construction costs on to buyers. Regional projects just can't maintain viable profit margins right now. So capital is packing its bags, leaving the periphery, and consolidating entirely in the capital city.
Moving right along to our third shift, the supply chain revolution.
Overall, private non-residential construction dropped a heavy 26.5% year-on-year. But just like before, that headline number completely masks what's really going on. The traditional commercial footprint is dying out. Office construction is down 16%, retail stores dropped 22%, and factories, they plummeted over 42%. But right alongside that, warehouse space has absolutely exploded, surging by nearly 50%.
Guys, this isn't just a slight tweak in the market. This is a highly aggressive capital rotation. We're talking about an incredible 791,000 square meters of new warehouse space added in just one single month. Capital is literally ripping up retail and manufacturing footprints to lay down logistics infrastructure. Thanks to global supply chain shakeups and the e-commerce boom, the market is screaming loud and clear, it doesn't want another storefront, it wants massive distribution capacity.
Let's bring this all together. Section 4, the new capital map.
The market has drawn a very clear line in the sand here. separating primary targets from areas of structural retreat. On the target side, where all the money is pouring in, you've got Tokyo condos, massive logistics warehouses, and those quick turnaround detached homes. That is your new safe haven. But on the retreat side, capital is rushing out of regional condos, traditional offices, retail stores, and old-school factories. If an asset can't guarantee a fast turnaround or serve the e-commerce economy, capital is dropping it like a bad habit.
So what are we really looking at with these April 2026 numbers? Well, it is definitely not a temporary dip, and it certainly isn't a seasonal anomaly. This is a rigorous, structural reallocation of capital. Money is systematically abandoning the periphery for the safety of Tokyo and the explosive growth of logistics. The real estate market is quite literally reorganizing its own DNA to survive this new era of high costs.
As this massive capital migration physically reshapes the nation, turning retail spaces into warehouses and draining regional cities to build up Tokyo, you've got to ask yourself one thing. Given this rigorous new reality, where will your capital go next? Are you going to follow the smart money into the fortress, or will you be left holding the assets of yesterday? Thanks for joining me for this explainer. Keep analyzing, stay sharp, and I'll catch you in the next one.